Welcome everybody to Stock Talk with Nico Kritikos. Today we're going to be doing some in-depth stock analysis on Disney stock. This is a stock I've never owned in the past, but I think everyone is familiar with the company and many of the brands they own. And this stock is now trading the lowest it's ever traded at in over 5 years, believe it or not. Last year, the stock topped out at $197 a share. Today, it's only $94 a share. So back in 2017, the stock was over $100, and it's lower than that now. So Walt Disney trades at a market cap of $171 billion. And the first thing we're going to look at on my checklist is the stock down or oversold? And yes, how I just said, lowest it's been in over 5 years, so that definitely is going to get a check. Has the revenue been increasing? Well, if we take a look at the last couple of years, we can see that Walt Disney's revenue has been increasing. If we come right here, we can see that it went up in 2019. So the years prior to 2019, it was a steady trajectory up. And then after 2019, then COVID hit, so that brought it down. And now we're still recovering and it's making its way back up. As for the net income, it has not been recovering. Well, I guess from 2020, it's been recovering, but still we're nowhere near where the amount of income they were making before that. So we got some ways to go there. Do they have a healthy price to sales? I put yes, because it's only a price to sales of 2, and this is still a growing company. They'll still be growing, at least 5 or 10% per year for the next couple of years. At least they should. And so a price to sales of 2 is pretty cheap. You're talking about a company that does last year $67 billion of revenue. So $171 billion is about to be expected. Then if we keep going on, we can see that how's the price to earnings based off of the current price relative to their earnings for this year. They have a forward PE of 17, which is pretty low. That's pretty average, pretty low though. And compared to how much growth they have ahead though, if you go ahead and look at what analysts have them doing, you can see here that the growth is, their profitability and their growth is expected to increase over the next year or two. So last year they did $2 of EPS. This year it's almost 4. And then 2023, they're going to do over 5. So that's some pretty strong growth right there. And for 2022, they're supposed to be over 35% or 35% revenue growth. And so this company, this is not like a dying company. This is still a company that has some growth ahead of it, mainly because of things like their streaming service now. And as they buy out different brands, different companies, that helps them continue to grow. So then we get to, is the company innovative? Do they have a moat? Absolutely. I think this company has not only are they innovative over the past, 50, 60, 70 years, but also the moat that they have in this company. So like you have all the different characters that they own, all the different brands and their parks. There are not many things that can compete with Walt Disney World. And not only that, but you also have characters like all the way back to Mickey Mouse to now they own Marvel. So they have Iron Man and all these different things that they own. So if we take a look here, we can see that they own ABC. They have an 80% stake in ESPN. They have Marvel, Lucasfilm, History Channel, Pixar, all these different things that they're making money through. And now that they have their streaming service, that is also a big growth vector for this company. Is it a growing industry? Yes, absolutely. I don't think people are going to stop going to theme parks anytime soon. People are not going to stop using streaming services, and people are not going to stop buying their products. So they're in a growing industry. How is their return on invested capital improving? Unfortunately, not really. Right now, the return on invested capital is a 5%, and I believe over the last couple of years it has been going down. So that gets a no. How are their margins? Well, the margins have also been going down, which is unfortunate because once again, 2017 to 2019, this company had net margins of anywhere from 16 to 22%, and then after that, of course, COVID brought it down to a money-losing company. But even since then, we're still not really close to where we should be. Right now we're at net margins of 4% when we should be at close to 20%. So we got some ways to go there. Then we have healthy cash flow. No, unfortunately not. If we take a look at their cash flow statement, we can see here that I believe their cash position has been growing. Yeah, so you can see from 2018 to now, we have $4 billion in cash to now $13 billion in cash. That's the only positive I see here. Everything else, look at operating cash flow, 14 to 5. That's not good. Investing is what it is. But the free cash flow has gone down dramatically from close to $10 billion to now $1.5 billion. That's not good. That's not a good pattern over the last couple of years. So that's going to get a no. Then we have diverse revenue streams. Absolutely. As I just said, the theme parks, the streaming services, the toys, the movies they make, everything. So they got plenty of ways to make money. Their balance sheet does have more assets and liabilities. And so if we take a look here, we can see they have what, about 200 billion in assets, a little under 100 billion in liabilities, which gives it over $100 billion of equity. So not bad. How is their price to book relative to equity growth? Well, their equity growth has been, so I gave this a yes, because the price to book is very low. Once again, it's only a, what is it, a 1.7? It's probably, or it's like a 2. It's like a 1.7 or a 2. And their equity has gone from, you know, it's almost steady, 99 billion to 104 billion over the last year. So a small increase, which is good enough. But if you take a look at the price to book, what is it going to be? So it trades at $170 billion and you have $100 billion of equity, a price to book of 1.9, right? Then we get to, is the equity over 10% of the market cap? Yes. How we just saw, it's over 55%. That's incredibly strong. Normally it's like 10% or 20%. Do they have a strong share buyback or a dividend? No dividend, but they do have a decent share buyback. The number of shares on the market, though, was not negative. So they're not buying back more shares than they're issuing, which is not the best situation, but it's under 1%, which means that's kind of insignificant. That's nothing to worry about. Are insiders interested? Yes, they are. Over the past year, you can see there's been some selling pressure on the stock, but there's also been lots of buying pressure. So you saw lots of insider purchases anywhere from $150 to $135. So that's good. And now we're far below that. So I do think Disney is a good buy at this price. And when you look at, if you think of a company like Disney, they own all these brands. Although some of their financials are not perfect, you have to think this stock is trading at over a 5-year low. Now, another thing to consider is how we looked at the net income is not anywhere, and the margins are not anywhere near where it was prior to COVID. So we still have a long ways to go. This company was doing what, $11 billion of net income years ago, and now we're only at 2 billion, maybe 3 billion. So we have some ways to go. How is this one? I didn't fill in because it's kind of subjective. It's kind of up to you. You need to kind of study the, go ahead and check out the management team and see what you think. Look at some interviews with the CEOs and stuff. I'm going to give this, I'm kind of want to say, I'm kind of going to say no, almost, just because of their financials and really the cash flow and the margins. The cash flow statement does not look good. So I'm going to give that a no, unfortunately. Does cash cover over 1 year of expenses? No. So if we look again at their balance sheet, we can see here that on their balance sheet, they carry what? I think it's 30 billion in cash, I want to say. Yeah, 33 billion in cash, current assets, and 1 year of expenses for this company is cost of revenue 50 billion. So they're not doing too good with that. I would like to see them have 50 billion in cash. Or not 50 billion in current assets. Doesn't have to be cash. So I guess we should put, yeah, that's good. So all in all, we have what? 1, 2, 3, 4, 5, 6. That's going to be a 12 out of 18. So technically Disney would not be a buy. And actually I was thinking about buying Disney today, but I chose to buy other stocks instead. I actually chose to buy JP Morgan Chase. That's what I bought instead. So certain stocks like that, I think, lately I've been buying more safe, companies that have huge brands like Starbucks, Home Depot, and today I bought JP Morgan Chase. So Disney is, I do consider Disney, I would say Disney is a decent investment at this price. It's just, there's a couple things like the cash flow not looking too good, but they've done such a great job over the past year with doing their streaming service, Disney Plus, and they've gotten, I don't know how much they have now, probably 200 million subscribers in, almost in a year and a half. So they have done a great job with that. And so I think this company is going to, have some growth ahead of it for the next couple of years or so. And I think overall it'll be a good investment. I just see other companies out there that are also trading low, and I've chosen those instead. But by no means do I think Disney is a bad stock or a bad company. So that is all for today. Thank you for watching, and I will see you in the next video.